Hey everybody, welcome. It is Mark Coe for Monday, October 23rd. I'm going to take a look in our levels here and see how they played out. I always talk about levels, and it's really the core of my strategy, my approach. And I often in these little video sections give a little couple 2-3 minute lesson on what happened in a very short-term time frame. Today I want to show you this big picture, why levels really matter, and think about what a level really is. It's a reference point to a time in prior trading, to a time in history that you know something about the market. And so let's think about today, Monday, dollar yen. Let's think about dollar yen. So I don't know if a lot of you watch financial news and read the Wall Street Journal or read any type of analysis, but the basic theme going across this morning as we walked into U.S. trading was one of a much stronger dollar breaking out. And I'll tell you what I told everybody in my room. What I said is, here's what you have right now. Here's essentially what you're sitting with. You're sitting with a dollar at top edge. That's what you're sitting with. I said it in euro. I said it in dollar yen. You're sitting right around 114. And so what that means is that if the dollar is going to break higher, you have to break those edges. You have to break those top edges. So think about how I come up with this and what really happened. This is a daily chart of dollar yen, and you can see this takes us back to this spring, April, May, July, right? And so what you have is this point right here. It's not a massive wide spread of top to bottom, but this is what the zone creates. 113.96 to 114.37. So you're talking a 40 tick area, and think about what that area represents. In May, that area represented a 1400 down to 108.83. So not quite 600 points. In July, it represented 114.40 as the highs, all the way down to 108.05. So you have a 114 to 108, a 114 to 108. Now you have the third visit in there, right? This is Monday. This little red candle that trades in there is Monday. So think about what we're looking at: 113.96 to 114.37. All right, so think of what you can do with that information on a shorter time frame: 113.96 to 114.37. Right? Think about what you can do with that. Right? So it's still the dollar yen chart. Here, I'll pull this back up just so we can see it. Still dollar yen. Now all we've done is move from a daily chart to a 2-hour, a shorter, I'm sorry, I'm on a 30-minute, a shorter time frame, right? So the idea is that you're going to grab your analysis from a bigger time frame. So the same spots I just talked about, 113.97, right here to 14.36, or something very close to that. All right, so there's your 40-point section. Now, this is how it's actually tradable. So that section has been there all spring, all summer. It didn't just get there last night. It's just that this is the first time that it's applicable, right? This is the first time it's dealable. So what happens once it trades in there? It starts to find a top. 1, 2, an hour and a half, it can't get through that section. Comes back, and so all you're really looking at is edges, right? Where do edges fit in? So think about how different your day is if you're a seller into that big section versus buying into the hype, buying into this dollar's go. Maybe the dollar does go higher. I'm not suggesting the dollar can't go higher. I'm not suggesting that at all. But what I am suggesting is look at it from this standpoint. That level was there for a reason. There were sellers there the last 2 times up at this level. So the idea that you can control your risk to about 35, 40 points, look what the reward became. Selling anywhere in that 114 area. This thing traded to 13 and a quarter. That's 75 points of upside, right? Just 75 points of upside. But the idea becomes that you now are not reacting after the movement has occurred. You're reacting before it ever even takes place. So you understand what's at stake there. But you understand it days, weeks, sometimes months in advance because you do this work. And so the difference looks like this. If you come in and you do all your work on 5-minute charts, 15-minute charts, you're constantly chasing momentum. You are. At the absolute height, if I'm staring at this thing on a 5-minute chart, first of all, I'm walking and going, oh yeah, all these prognosticators are correct. It's a very strong dollar yen. This thing gaps higher, doesn't it? It gaps higher to start the evening. I mean, at the absolute height, it looks really strong. Why would I be doing anything other than chasing that momentum higher? And on the first pullback, I'm probably thinking, oh, this is a real good spot to buy. It's 1380. And then as it crashes through, think, well, clearly this level has to be good to buy because that's where it gapped to, and that doesn't hold. And so all of a sudden the momentum idea looks a little different. But you don't have to make trading as stressful. Your short-term investing, your short-term trading, but understand the importance of where you're looking to deal. That's what gives you a leg up on the rest of the retail world. That's what gives you the idea of your edge, which is how can I position myself? And this should always be your intent. How can I position myself to earn more than I'm risking? That should be the intent. How do I risk less to earn more? And it doesn't come from a standpoint of watching 70 points sell off and then say, well, I'll just sell it down at the bottom. That does not work. That's constant retail bad decision. So think about it next time you're looking at a long-term chart. Find those levels that the market reacted from. Find those levels that the market wanted to move away from, and look at that with your short-term trades. All right, so for Monday, 23 October, it's Mark Coe. Cheers.